afternoon. Thanks for tuning in. You're watching Countdown on Bloomberg Quint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. These are the top headlines that we're tracking at this hour. The Nifty and Sensex trade 0.5% lower, with the Nifty falling below the 10,900 mark. Yes Bank and Indiabulls Housing lead the decline. Thyssenkrupp challenges the European Competition Commission's decision to block its proposed joint venture with Tata Steel. NMDC is down more than 5% despite securing a temporary stay from the Mines Ministry for the Donimalai mines. DLF is down more than 10% after the Supreme Court issues a notice seeking more details on allegations of hiding information during a QIP offer. The company claims the allegations are baseless. The Employees Provident Fund has decided not to make any new investment in bonds issued by private companies. Good afternoon, Neeraj. Well, we're clearly underperforming the globe and only scaling lower now.
Yeah, well, at some point of time, the markets needed to catch up with the reality. We had stayed up for too long, and the voices that are coming out from India, no action or no support being given thus far, also adds to that pressure. I mean, there was some prop up last time. Remember when we were at 10,900 and a couple of stories done about some stimulus coming very, very shortly led the markets higher. No sign of it. You probably have the market doing what it does best, which is go down. Almost no reason really for the market to do otherwise. 10,800 for the Nifty, with comfortably down. I mean, yesterday everybody's talking about 10,900 being the key support level. Suddenly the chorus has shifted to 10,800, and I dare say if we go to 10,500, then that's the level at which everybody says this is the main support. Frankly, I don't think we're finding too many support at any of those key support levels, to be honest. Bring up the Bank Nifty as well, about 1.41% lower, 385 points gone for the Nifty Bank today. And the heat map is a sea of red. I mean, you might have an odd outing of green, like some Britannia, maybe TCS, some defensive names like HUL, Tech Mahindra, HCL Technologies. But look at the cuts that have come in. Yes Bank is down 11%. Vedanta, another 7.5%. Indiabulls Housing, 6.5%. Coal India came out with numbers which are okay, about 5.5% down. Bajaj Finserv is down about 4% in trade. BPCL, UPL, the list is endless. It almost seems a replica of yesterday's trade, but for the fact that maybe the quantum of cuts have varied between the top losers, but the size of the cuts for each of these names, the losers that have come out, are fairly large and disconcerting. I'm guessing the scene is same at the broad end of the spectrum too, Devina. The market breadth can't be positive on a day like this.
Yeah, Neeraj, you're right. And in fact, to just take away from the point that you spoke about with regards to the markets expecting a stimulus, I think there were some comments from the CEA, talking about the fact that there should not be an expectation of a stimulus, and the government is going to be taking a very calibrated approach looking at how the situation on ground is. So I don't know whether that stimulus is actually going to come anytime soon or no. But this is what you've got, and like Neeraj highlighted, the broader market space is also witnessing its fair share of pain. That discount keeps widening, and in today's session at least, the mid caps and the small caps have taken a big drubbing. Taking you through the individual stocks, DLF is down about 12% odd. At one point was down 18% on the back of that Supreme Court notice. NMDC, some clarifications and a stay order, a slight silver lining that was there in the early morning session has reversed by afternoon, keeping in tandem with the rest of the market sentiment. NMDC is down 6%. CCD, however, manages to hold on to that upper circuit gains over the last few days, though they have categorically said that, ITC is, there is no talk of selling stake to ITC. The stock's up about 5% odd. Other stocks on the move. Yesterday's big loser from the Tata Group, Tata Power, has recovered some of those losses today. It's up 7.5%. Hathway continues its swell ride, and today's session now is about 35. The stock's up 6.5%. And PI Industries is up about 3% odd. So a few bright spots within the larger sea of red. Thomas Cook, a big 20% dip in today's session. You've got Sterlite Tech on volumes down 13.5%, and CG Power. Ever since those, the auditor flagged off all of those concerns, the stock has been in just going down one way. Big volume buzzers, LIC Housing Finance, obviously 5.5 crores of that is on the back of those bulk deals that happened in the morning, where an investor wanted to sell out of $200 million worth, and 8.5% lower is where LIC Housing Finance is. Mahindra CIE and Yes Bank are the other two stocks. Yes Bank we spoke about, but the volumes are massive. 19 crore shares have been traded already. Let's take a look at now what's happening in the futures and options space. Navneet joins in for that. Navneet.
Thanks for that, Davina. Well, the cues are not that great because fresh shorting continues on the benchmark indices. That's Nifty as well as Bank Nifty. We've observed open interest surging for both of them. And in fact, right now, the Nifty futures have been trading with a discount of about 8 to 10 points, 1% lower for Nifty. Just want to highlight, we've also breached the 10,800 mark. Remember, the next level that the street was watching out for was 10,782. Now, that's a recent low, which was seen on August 5th. So that too seems to be getting breached now. So 10,787, 1.2% lower for Nifty. Shorting continues here. For Bank Nifty, I think open interest is up somewhere about 15 to 16%. Yes, and that's down about 1.7% as we speak. The discount is at 35 points. Options data, today's the weekly options expiry, and I think we've been breaching all the levels. So 10,800 has been breached. The recent low has been breached. So probably now you can watch out for 10,750. All the psychological levels will become important. But call riding has been continued since yesterday, as you can see on the screen. For today, 10,900 as well as the 11,000 call strikes are seeing some bit of, not some, actually a lot of open interest addition. And the lower level strikes, the 10,700 put has seen open interest addition. Now 750 will be a mark to watch out. Very quickly on the stock futures side, Bajaj Finserv, a Nifty counter is down about 7 to 8% now for the week. We've seen fresh shorting, particularly in today's trade, because we have seen surge in open interest coming about. That's up about 10%, 4.5% lower for Bajaj Finserv. It's been down for all trading days this week. LIC Housing has been in focus today. Open interest build up seen, and the stock's been trading below its 200-day moving average. And lastly, DLF, it may have recovered from the lows of the day. It was down 19 to 20%, but right now the stock's still trading below its 200-day moving average. Open interest surge has been about 22%, indicating traders are betting on the short side for this one.
All right, so a lot of those stocks seeing heavy short positions getting built in. Let's get in a market sense from Prashant Prabhakaran, Senior President and CEO at ICICI Securities. He's joining us on the show right now. Prashant, thanks very much for taking out the time. And, you know, the last few days have been extremely difficult to gauge and to put a finger and say, okay, you know, you might actually have come to these lows and you could actually see a bounce from here. We're breaking through all of those psychological levels on the downside. What is the advice you would give now?
So the fact remains that cash is going to be king at least for the next 2 quarters. So in case you are an investor who is still sitting on cash, I think so you should wait for the next 2 quarters pain to get over. The liquidity pressures that have driven markets to the present levels will continue to unfold unless there is an intervention which allows the liquidity to flow a little more smoothly into a lot of segments that are there in the market. If that doesn't happen, then you have pain in the NBFC sector, which is affecting the entire SME and MSME pack, which is there. Shadow banking, which lent a lot of money to the real estate sector, is going through painful times by itself. So it's a tough phase to actually be an investor in. If you're sitting in profits, our advice simply remains that you should book partial profits, have cash available, because markets will correct a lot more is what our feeling is.
Okay, you know, interesting you say that, and the fact that, you know, how different is this cycle from what we saw in the month of October? The index fell 16%. We went down to levels of about 10,000, almost nudging to break 10,000 on the downside. But the pessimism wasn't still at levels at what we're seeing them to be at now, when we're still at about 7,800. What's different this time?
So liquidity wasn't as bad as it is today. You've got to understand that most of these shadow banking names of NBFCs have been able to repay a lot of loans without default, except for DLF and the IL&FS crisis, which has gone by and is still continuing. Most of these guys have been able to roll over. But nobody is willing to lend to these names, and these names supported a lot of mid-level companies which are there, mid-caps that are there. You speak to any mid-level, mid-cap promoter, and you'll suddenly realize that they just do not have the money either to think on investments. They are more worried about making sure that their company functions smoothly, working capital is available, which itself is at a premium today. That is one portion of it. The second portion remains that you have every second day a new problem that is arising. Names which were never in the list as far as NPAs were concerned for most of the banks have started coming about consistently enough, which are surprises. And if the same trend continues, corporate defaults we are used to, you might have the start of a retail default cycle which might start off very soon, because if there are going to be job losses, there is going to be pressure both on mortgages that most of these people would be sitting on. EMIs will start defaulting either on personal loans, because the largest growth that has happened in the credit space has been into the unsecured loan space that has been there. So you have trouble still brewing up. It will be a wait and watch period for any investor to see how it finally unfolds. But there is going to be immense pressure on the banking space, and that itself is around 32% of the entire Nifty weightage that is there.
And in such a scenario, while cash might be king, the question that would come to mind is, what are the downsides that we are looking at? If indeed the financials come under pressure, it will not be alone. The other sectors will anyways continue to remain under pressure. What levels are we talking about?
So I wouldn't like to give a level.
No, okay, I'm not asking you for a Nifty target, Prashant. But all I'm asking is,
the last time.
No, Prashant, I'm not asking for a Nifty target. My larger question is, do you anticipate that a downside of maybe 7 to 10% is not an unrealistic probability?
Very true. I think so. That is very much possible. You have got to understand our feeling is that a lot of mid caps won't be able to manage this liquidity cycle, and there will be problems as far as repayments of their present OD limits that they have with most of the banks and the financials are concerned. If that happens, the default ratio is continuously going to increase, and there will be pressure on the system that will be there. So today, banks who are sitting on liquidity, you'll suddenly realize that in another couple of quarters, when you have names which you have never anticipated will slow down their payments, there is going to be pressure in the system. And finally, you will end up talking about returns in the market only when there is growth in earnings. That itself looks pretty dicey, at least for the next 2 quarters. This quarter definitely is a washout quarter because there is no liquidity that is available. You talk to any mid-level corporate, you will end up finding that they are struggling to end up surviving. Forget thinking about growth and future. They are saying that let's get over the next couple of quarters. If we survive, then we'll talk business again.
Okay, Prashant, the other question would be, are there pockets of defense, or you believe cash is the biggest pocket of defense?
Cash is definitely the biggest pocket of defense. You've got to understand that 12% weightage of auto, that is under pressure. You talk about 32% weightage. We ourselves are seeing that there is going to be pressure that is going to be built up in the next 2 quarters. You take telecom, you take real estate, that's practically around 60% of the entire Nifty space that we are talking about. The only ones which are going to escape in this, which are already valued very high, are the ones who do not have debt on their books or have very low debt. Anybody with debt is going to have tremendous amount of problems struggling to repay their entire loans out. You talk about any one of the companies which have gone in for large-scale acquisition on a global scale or even on India scale is going to struggle to end up meeting those obligations. So either you look at low debt companies or no debt companies, which will end up ensuring that you at least are clear that though it is going to be not very high returns on your portfolio, you are not going to be losing money. But those valuations are also very high. Last time when I had come on your channel, I told that I was very uncomfortable with valuation. I think so that was a good in March, April of this year itself. But this time the situation is totally different. It has deteriorated to a different level altogether.
Well, Prashant, point well taken, and all these companies which are highly leveraged, we are seeing the result of that, at least on the screen, in terms of the stock prices of these firms. But let's say, when you see signs of cycle turning, which pocket would you look at first?
So the way the downside from now on for the next 2 quarters is going to be led by the BFSI space. You will also see the recovery coming in from that space, because unless credit is made available, you're not going to see a large jump in recovery of earnings that is going to be there. Finally, people need to have money to end up running their businesses, thinking about future expansion and growth. So you are going to see a very, very slow progress, because the bottom is going to be painful. Even if the fall is as high as what Neeraj just talked about, the 10% level, I think so the bigger worry that I have is that there's going to be a time-based correction which is going to be painful and a longish period of wait, because the economy will take time to recover. Consumption, the moment it drops below a particular level, people do not just come and spend the next day onwards. They are conservative for a longer period of time. The negativity takes time to come out before they start spending again. So it will be a time correction also, which is due along with a price correction that we believe which is going to be there.
Okay, and talking about the safe havens, that's one pocket actually which has been bucking the trend at least this week, and that's the FMCG, some of the FMCG stocks. Yesterday we had Nestle hitting all-time high levels. Today you've got HUL. Well, I totally understand there is consumption slowdown, but these companies have actually weathered the storm, though there is slowdown, but they've managed to put up a good show even in a weak environment. If you were to take a bet in any of these companies in the FMCG pack, which one would feature on top of your list?
See, if you end up looking at the names that you've spoken about, none of them have debt onto their books, and they are valued at a premium that is there already in the market. But still, if you end up asking me to pick, I'll still pick a Nestle because there are growth targets that they have set for themselves, which are aggressive by nature, and they have the financial backing that is required to end up getting through this, and they are still lower valuation as far as an HUL is concerned. The one that I'll avoid at this point of time, it has broken a multi-level low, has been ITC. It is again a low debt company which is there, but the amount of investment that they have made into a lot of companies getting set up has still not given the ROCE which is there. So these two counters having opposite views, there will be pressure on ITC, and there will be some good times as far as Nestle is concerned.
Got that. Prashant, it was great chatting with you and getting your perspective on the markets this afternoon. Appreciate it. Prashant Prabhakaran there of ICICI Securities. Markets is still looking wobbly, though it's managed to scale back above 10,800, now 10,812 on the Nifty. So not on the lowest point of the day, but we're not out of the woods from any stretch of imagination. 27,297 on the bank Nifty right now, which is also struggling. A massive 400-point cut on the Nifty bank right now. So that's pretty close to actually taking down that 27,000 mark. Maybe if this weakness continues a day more, and you'll probably have yourself staring at numbers within the 26,000s. But taking a look at a few other movers before we go on to our next piece, Vedanta has seen a big slump, 9% on Vedanta. That one has taken a knock in today's session. We've usual suspect, Yes Bank features on that list, but Vedanta, it's a surprise there. Bajaj Finserv is down 4% at 6,800. Then you've got the likes of Tata Motors again after yesterday's 10% cut is down about 4%, followed by UPL, IOC, Z. All of these names looking extremely weak.
Okay, well, we've been speaking about what's happening to some of these highly leveraged companies and some of the metal names which are anyways in a down cycle. I think it's pertinent to point out what's happening to two metal names. And unfortunately for NMDC, you would have to say that despite the kind of clarification that has come in, the stock has corrected about 7%. So it corrected day one, which is Tuesday, on rumors that there will be an order pass. Then it corrected on Wednesday when it officially came out that yes, maybe there is an order pass, and today there's some clarification from the Mines Ministry. I presume that there's a bit of a stay on that state government decision in Karnataka. The stock is still corrected about 7%. By the way, it's happening on very high volumes. So keep that. This is one thing in mind. And then, of course, Tata Steel has some news for itself as well, which is the other thing that you should watch out for as well with regards to Tata Steel as well as Thyssenkrupp. So let's get in Nikki Mirchandani, Shu Johnson for both of these things. Nikki, one, Tata Steel stock price has recovered, but two, NMDC continues to remain under pressure.
Okay, I'm going to take Tata Steel first because it's the latest development that we received from Thyssenkrupp press release, which has challenged the European Commission decision to bar the joint venture with Tata Steel. It's filed a complaint with the General Court of the European Union and has said that the commitment which has been, or the remedies rather, which have been provided by both the companies are enough to allay concerns. It has also said that European Commission has for the first time set out a restrictive market definition which unduly extends the scope of an existing competition law. It also says that the decision doesn't factor in the importance of imports and buyer-side purchasing power. It's called a decision wrong and has a far-reaching impact. Now, this to an extent offers some kind of hope that the deal might, just in case if it's a revival, Tata Steel could get away with this European operation, because that's been a pain point for the company and the financials of the company. The European operation overall has a debt of around 2.2 billion euros, which is an uncertainty for the stock and has been weighing on the counter significantly. So any kind of solace which is coming through on account of this is definitely going to be a positive for Tata Steel at the moment.
Okay. And NMDC, of course, continues to remain under pressure because the Mines Tribunal of the central government has stayed the decision by the Karnataka staff. I think you spoke to the management as well. Tell us more about it.
You know, Neeraj, it's just a temporary relief right now which has come through, because the order for Karnataka government has just been stayed until next hearing. Until now, the state government is yet to prepare a statement of objections which will be presented in a span of next week, where the two parties are going to decide whether or not Donimalai mine would be back to the original operator. But then, you know, at the application which has been filed by NMDC has clearly stated that the Karnataka state government decision to auction these mines is in a little haste, and also is in violation to the High Court order which came some time back, which suggested that you know, the royalty demand of 80% is completely unfair, or rather should be kept aside. So these are 2-3 parameters. But then we spoke to the management of the company, and they have said that the hearing of the case is still not decided. But let's listen to the slides of the conversation.
We are actually satisfied with the order of the appellate authority or the revisioning authority. It has been stayed. They have heard us. In the next hearing, which has not yet been scheduled, we hope that the state government will also be present. And as of now, since the order has been kept in abeyance, we will have time to convince people, argue our case both in front of the government of Karnataka. We hope an amicable settlement is reached as much earlier than expected. We will now try and convince the state government as well. And of course, the central government, the CMD has been talking to everybody. We believe that it will be justified and in the interest of the industry, in the interest of the company, in the interest of the state government, and in the interest of the country if the lease is renewed as it was decided by the High Court.
All right, those are two stocks you need to keep an eye on, Tata Steel and NMDC. The other stock to watch out for is obviously DLF. Supreme Court has issued a notice to DLF regarding the failure to disclose material information during a QIP. That's according to a Business Line report. Bloomberg Quint spoke to the DLF management, which claims that all necessary disclosures were in place. Darshan Mehta, he's standing by to tell us all about that development. Darshan.
Yeah, so basically the Hindu Business Line report does indicate that there were petitioners that have put in a petition on the Supreme Court indicating that certain land deals were not disclosed in the QIP, and that is what caused concern. And one of the things that the report did indicate was in case it goes against them, DLF will have to return the entire 5,000 crores of QIP, and that's caused panic. The counter fell in almost 20% in trade, has recovered, is now down just 10%, but nevertheless the counter is down in trade. We spoke to the management, and a couple of things that they clarified. First of all, they said that initially it's the same group that had pointed out certain issues in terms of disclosure, even when the IPO was filed, even when later certain documents were filed. So they believe that certain these groups are targeting these disclosure loopholes to target the company. That is what the management is saying. Now, the land that they spoke about was a 5 to 6 acre land, and there is no related party transaction, nor does it belong to DLF, nor does it belong to any of the subsidiary, and that is why this was not disclosed in the QIP document. And they believe that they have disclosed all the necessary information that was there in the QIP. They're saying that they have not received any coins or cause of any count of show cause notice from the Supreme Court in this matter. So the counter did, after the interview and after all the clarification, the counter did manage to react significantly from the lows of the day. But let's also listen to what Ashok Tyagi had to say on DLF and the issues that are pertaining to it.
Right from our original IPO in 2007, there have been certain, vested interests who have been trying to, find disclosure loopholes. Since then, virtually with every public issuance that we do, the same set of vested interests try to raise some fresh concerns or some fresh issues. And this QIP was no different. So when this gentleman did not, get any relief, they approached the Supreme Court, filed towards the application in the Supreme Court, including wanting to get impleaded in the original land case and wanting to seek issues on this QIP disclosure. There's no censure, no observations, no show cause notice, as some people are saying. It's an extremely routine issue, and obviously we're working with our lawyers, and we'll reply to it in due course.
All right, that's commentary coming in from the management of DLF, though the stock's off the day is low, but still it continues to trade in the red, down about 13%. Let's move ahead and talk about the slowdown that is pretty much pronounced now. The automakers have been facing a slowdown for months. The demand in the FMCG space has also been weak. Yatin Mota spoke to Jaideep Goswami of ICICI Securities to understand if a revival is around the corner and what measures can be taken to spark a revival. Listen in.
The growth numbers are kind of quite weak till the numbers that have been disclosed end of July, and the similar trend is still continuing in terms of weak demand environment and the pressure that the value chain is facing, both the distributors and ancillaries with regard to access to credit. One of the positive factors for the industry as a whole is obviously significant improvement in monsoon spread so far, which was an additional area of concern earlier, but recently the monsoon has played out very well. So there is a hope among auto manufacturers that there should be a revival coming around the festival season that is coming up. And because the degrowth started towards second half of last year, technically speaking, the numbers may still look good for the second half of the current year on year-over-year comparison. However, the benchmark that industry is considering as a kind of metric by which they will judge whether a revival is coming is the FY18 numbers. So that is some time away, and we may see a situation of weak environment prevailing, and there is a role to be played by various entities, by the banks and the ecosystem to do a broad-based confidence building measure, which the society as a whole have to do in order to kind of give a boost in the sentiment of vehicle demand.
Jaideep, specifically talking about the confidence boosting measures, be it the auto sector or be it the general economy in terms of the demand slowness that we have seen, do you think the government stimulus needs to start first, or do you think the rate transmission, given the fact that RBI has cut rates, however the transmission is not happening, that will play an important role? What, according to you, should happen first in order to aid the overall sentiments on the ground?
In historic terms, if we see that every time there was a government stimulus package, the auto industry has seen a V-shaped recovery. That is the experience of 2001, then 2009, and then 2014. So all the time that government has announced very focused, targeted stimulus measures, it has had a positive impact in terms of recovery of demand. So similar steps may be expected. There is deliberations going on between automobile industry and the government agencies as to what are the best steps that can be taken in terms of GST rate adjustment or other cost measures that can be postponed, if not postponed altogether for a limited period of time, a kind of a cost reduction initiative on vehicle cost of purchase, if it can be initiated. Obviously the industry is going through unique kind of Uber and mobility related, a different operating environment in which we are seeing that the fundamental excess demand that comes from this segment has kind of weakened. As a result, there is need for a stimulus measure for sure. However, there is no problem in banking sector taking the steps to pass on the transmission of lower interest rate that RBI has been signaling. So both are needed, but probably stimulus is very much needed at this point in time.
Okay. Jaideep, we just concluded the first quarter earnings season. A lot of caution in management commentaries across sectors. As a house, what is the view in terms of FY20 earnings outlook? And more importantly, if you could share what were the broad standouts for the first quarter earnings and what kind of a trend do you see building up for FY20?
I think the underlying sentiment is one of risk aversion at all cost. So there is more and more concentration of portfolio position by domestic and foreign investors. Clearly the sectors which have been able to kind of withstand a kind of weak demand environment are technology sector, and post good monsoon the consumer sector, FMCG, select companies in these two space could be the sectors where we can see a kind of somewhat of a resilience in the earnings outlook going forward. So we have to choose the market leader in this space. The sector which can give opportunity for selective investment opportunity is in the private banks space. Clearly the sector where the stress has been less, and they have been a net beneficiary of the crisis that has unfolded in NBFC space in their portfolio build out side, and they will also gain in market share. So these are the 2-3 very select segment of the market where we think the foreign and domestic investors are interested, and we have seen deal flows in these areas also getting lapped up by investors. So it's basically going to be more and more selective and stock picking kind of environment where one needs to be very careful and kind of tide over this crisis that we are in right now.
Okay. And Jaideep, quickly, since you track the BFSI space very well, there is a lot of cry and a lot of hue as far as the entire NBFC segment is concerned. A lot of companies are getting impacted because of the tight liquidity. On the other hand, we have the IBC process which has got slowed down because of various procedural reasons. And on the other hand, we have the private sector bunch which is doing well in terms of the share price performance as well as the investor interest. So in the entire BFSI space, how do you see earnings move in the second half of this financial year? You said that there is opportunity for the private sector banks where stress is reducing, but what about the NBFC segment as well as the PSU banking lot?
In the NBFC segment, we are seeing clear divergence between the NBFCs which has got access to domestic and foreign external commercial borrowing related liquidity. Those are the companies which are differentiating itself vis-a-vis a large number of other NBFCs which are clearly facing a growth related problem due to their lack of access to liquidity on the liability side. So there will be a separation of earnings growth performance in the second half, and the NBFCs which are stronger and which are having higher rating and access to domestic and FII liquidity will be the companies which are likely to show growth, such as companies in Shriram Group.
Well, that's a couple of good market opinion already, and now get in more. It's also important to get in some technical opinion at a point of time when we are now convincingly below 10,785. Adrian Mendonca, Senior Technical Analyst at IIFL, as well as Rahul Randeria, Independent Market Strategist, join us on the show. Gentlemen, both of you, good afternoon. Thanks so much for joining in. A bit, we'll also get in Dipan Mehta, Director at Elixir Equities, for a check on the fundamentals. But Adrian, to you first. 10,900 was being touted as the strong support. Not only has that been sliced through convincingly, we are now down below 10,800. My question is, if we close below this 10,800 mark, what are the downsides that open up?
Hi, good afternoon, Neeraj, and thank you for having me on the show. So, definitely, the overall stance has completely changed to sell on rally. So, if you noticed, past week the rally that we saw was completely given away. And yes, the question that you asked is, a very important one, because this could actually lead to another, downfall, which could actually lead Nifty lower towards the 10,500, 10,550 zone. So, I think if we are going to close below 10,780, 800, I think that could be the deciding factor where things can open up, pretty bad on the downside. Even the Bank Nifty has broken below its August lows. We have seen Nifty also breaching below its August lows. So I think if you're going to close below that, things can get a little more worrisome going forward. So my stance would be cautious, and would avoid actually going long in any of the indexes, and also would avoid going long in stocks that are badly beaten down, because nowadays speaking to a lot of clients, they have got one kind of a habit wherein they are wanting to lap up stocks that are badly beaten down, but markets are actually punishing the ones that are beaten down badly. So I think it is better to stay away.
All right. Rahul, what's your sense?
Yeah, good afternoon, Devina. If you look at the last 3 to 4 days, and if we see how many points already both the indices have corrected, Nifty has corrected 350 points in the last 4 days, as well as Bank Nifty has corrected 1200 to 1300 points on the daily charts. Now the setup seems to be oversold, and if we look that today is an weekly expiry, and looking at the global setup, and today's market reaction seems to be overreacted because of the call writing, major or tremendous call writing seen at the higher levels. So that is the reason why we have seen the pressure, and we have not seen a minor pullback even on the intraday basis. But looking at the setup on the daily charts, Nifty has taken a slight support near its downward falling trend line, which was if we joined in last 4 to 5 months. So definitely we could see a pullback, technical pullback from current levels, not on intraday basis, but yes, for next maybe for a couple of days. So high risk traders can buy at current levels with a stop loss below maybe 10,690 for a technical pullback of a psychological mark, which is 11,000 in the next couple of days. Same thing in Bank Nifty, we are expecting a technical pullback from the current levels towards the level of 27,700 with a stop loss of 27,900 on the downside. It would be volatile, but yes, looking at the oversold setup, we would recommend to buy with a strict stop loss.
But would you then sell on that rally at 27,700?
No, looking at the downward falling support, I don't think so. That could be a opportunity to sell at the higher levels, because I feel that market is trying to make somewhere bottom, or it is in a process of making a bottom, because there has been a tug of war in the last couple of weeks. So maybe it will take some time, but yes, definitely looking at the heavyweight stocks which are showing some sort of resilience at the lower levels might pull up the index from the lower levels in the coming days. So definitely I would be a buyer, but on indices with a strict stop loss, and on the frontline heavyweight stocks.
We were just talking about it, right? How the system is so heavy on those shorts.
I think for the longest time we've been discussing how oversold this market has been. Yesterday, once again, the Nifty PCR fell below the mark of 1, which indicates that there are a lot of shorts being built in the system. And I also want to point out, I think today both Nifty as well as Bank Nifty, it's breached the series low. Also, the recent lower Nifty was about 10,782, which was seen on August 5th. That's been breached at least in today's session. And for Bank Nifty, it was somewhere about 28,204. So both very crucial levels breached. Let's see if there is more downside left, considering if you look at the index futures data on the FI side, positioning on the short side is heavier, almost to the ratio of about 70%. But having said all of that, let's get you some individual trading strategies also going from our technical experts. Hadrian, let me come to you. Which are the stocks that you're recommending in trade?
Yeah, so both my stocks are on a sell side, and the first stock that we are bearish on is Bank of India. The stock has actually resumed its downtrend. The lower top, lower bottom structure has been resumed. We've seen past 3 to 4 days consolidation base has been broken. So I think definitely we could see further downside for Bank of India August futures. So we are expecting a short-term target of 60, keeping a stop loss at 64.1. The second stock that we are bearish on is an Ashok Leyland. Again, the same, the lower top, lower bottom structure is getting reinstated again and again. Any kind of pullback rally is being sold into. In fact, the strong base that Ashok Leyland was indicating has actually been broken on the opposite side, that is on the downside. So I think again we are expecting a short-term target of close to 56 rupees on an August futures, keeping a stop loss at 59.5.
Okay, so those are individual stock bets coming from Hadrian. Rahul, what about you? You've got 3 buy calls for the day.
Yeah, definitely. We have a buy call. First is a buy in Axis Bank. The stock is trading and seen some sort of strength at the current levels, because even in such a sell-off today, where the stock is managing to hold on the grounds. So definitely we could see a short covering move in the coming days. One can accumulate the stock in the range of 665 to 655. On the upside, we feel that stock can test or fill the gap of 707 with a stop loss of 642. The second buy call is in HCL Tech. Rupee depreciating, which would would support the IT stock. So definitely one can buy HCL Tech in the range of 1082, maybe an end on correction to 1067. Upside positional target would be 1126 with a stop loss of 1049. My final buy call is in Divi's Lab. Again, some sort of bottoming out formation is being seen in the pharmaceutical stock as well as on the index, pharma index. So definitely Divi's Lab can be bought in the range of 1567 and on corrections to 1546 with an upside target of 1635. A stop loss would be 1515.
I'm not seeing someone give 3 buy calls even when the markets are going up. Markets are going up.
Rahul is clearly supremely confident about his charts. Let's see. Maybe the bulls need it.
One more stock. He had given buy call on HCL. I think TCS is sitting at days high. Looking at the IT stocks, TCS is now up about almost 2%. And can we just pull up the rupee as well? I think it's weakened almost 0.5% in today's trading session. It's inching very closer to the handle of about 72 to the dollar.
Well, maybe that gives IT some fillip, but let's wait.
But it doesn't give a fillip to the rest of the market.
The rest of the market, yeah. But somebody who looks at all of this so very closely, it's a great time to get in Dipan Mehta, director at Elixir Equities. Somebody who's seen many such cycles, looked at the screen so well, tracks IT so well. Dipan, good having you. Thanks for taking the time out. Just what the screen is telling you, Dipan, is it showing pain which will last? Because you would look at the buying patterns, the quantum of red on the screen and try and judge that too.
It's like a horror film. You better cover your eyes. That's what the screen has been the last few trading sessions. And what we are seeing is truly capitulation. And even for someone like who's been in the market for 30 years, we certainly have been shaken, especially with the way the prices have fallen in some of the mid-cap stocks. I think even a slight bit of bad news and you see the stock going down 10-15% or so. And doesn't matter what the valuations are, price to book, price to cash. I think all the fundamentals as far as the small mid-cap stocks are concerned have been thrown to the wind. And it's like a complete exodus that we are seeing in a whole host of stocks. So while the mid-cap Nifty is down about 30% or so from its top, the real pain is even more than that when it comes to actual portfolios. So I think it's really a classic bear market. And in bear markets, you will have such blowout sell-off days. And I think that one has to live with it, because there's very little an investor can do also. I mean, to sell at this price point is a very difficult task, especially if you don't need the money and then you don't have any other avenue for investing. So that kind of adds to the dilemma of an investor. And in our experience, whenever we have seen such really huge sell-off days or sell-off periods, it just makes sense to just hang in over there and remain invested and hope that in 2-3 years' time, that decision has paid off handsome returns.
I'm glad that, this is a very candid answer, and I'm glad that this is happening, because Dipan is saying that, hope for in 2-3 years' times. Nobody's now talking that, okay, by in the next 6 months, we'll have a great festive season and a great Diwali and all things will be back to normal. This is probably a more realistic answer that we're getting today, right now from Dipan, and then of course earlier from Prashant Prabhakaran as well. Dipan, would you have in your own personal portfolio, or even in your client's portfolio maybe, sit on a bit of cash right now, or maybe a bit earlier, and are you continuing to do that?
See, what happens with clients and our own portfolio is that there are always incremental cash flows which may be deployed into the equity market or elsewhere. And it's just that last several months we haven't deployed any of those incremental cash flows. So automatically the cash levels in the portfolios tend to go up, whether it is directly in our portfolios or with clients in their specific bank accounts. So just that at least at our end, we never managed to sell off any time in the past 1 year or so in a major way. But at least incremental flows is what we prevented from getting into the market. And those cash flows and those savings are kind of protected at this point of time. And it's going to be difficult to invest that money also, because every time you think this is the right time to invest, the market suddenly goes down by another 2-3% or so. And I think the best call that one can take right now is to miss the bottom whenever it does happen, but wait for that solid pattern to re-emerge where you have higher tops and higher bottoms. At the same time, clearly at the corporate earnings level and what managements are saying, because actually a management commentary will precede the improvement in profitability or the quarterly numbers. So I think we are trying to keep an eye on these two things: management commentary and on the technical side, higher top, higher bottom type of pattern, before we start even nibbling into the stock market or increasing the exposure with the sort of cash we have kind of hoarded up over the past few months or so by not investing in the market.
You know, in the morning we had a very interesting data point which Darshan had highlighted, and this was amongst the all India listed stocks with a market cap of over 100 crores and how these stocks have done in the recent past. So over 90% the stocks that are down from their lifetime highs, over 90%, about 166 stocks, so that's 11% of the market. Between 80 to 90% is 10% of those stocks which have declined. Between 70 and 80%, you can just see that on your screen. I don't need to really read it out, but you know, it's sort of colossal damages where you can see across the board, deep cuts, 52-week highs, and the kind of cuts that they've seen across the board. But you know, Dipanjan, where do you say that you know valuations, when you look at historical valuations, they look appealing, they look attractive. Everything that looked attractive 2 months ago is become even more attractive now by the looks of it. So then what's the idea of sitting on cash?
No, I know, you know, and you're right. Maybe stocks were attractive 2 months ago, and maybe 2 months down the line also, if this kind of trajectory continues, you'll find them to be even more attractive. The thing is that, you know, the price to earning multiple, price to book, and all the other various valuation parameters are in a way qualitative, and then they rely a lot upon the visibility of earnings. They rely upon the market sentiment. They rely upon certainty or level of uncertainty, be it political or economic. Of course, you don't have any political uncertainty, but we have a lot of economic uncertainty. So price earning multiples, price to book are kind of, you know, qualitative factors. And who knows whether the right price to pay for a business is 30 times or 20 times or 10 times. In bull markets, such businesses will go at 40, 50 times also, but in bear markets, they may go at single digit P multiple. So, you know, it's just an evaluation of an individual investor that he feels the price points are cheap or not. And if you had a lot of cash and had you sold earlier, or if you're looking at making a fresh investment, then these are great times. I mean, you know, you could buy at leisure, spread your buying over several weeks or months, and you can pick and choose which stocks you want to buy, along with a lot of these stocks which have got suspect corporate governance or business model. A lot of good quality businesses also are available at attractive valuation. And then there are a whole host of businesses which have had excellent track record, but have been you know, kind of impacted by short-term cyclical or specific issues because of which they have corrected the way they have. And once, you know, the cycle tends to turn, these companies will again start performing exceedingly well. So these things will keep on happening, but it's an investor's perception whether stock prices are cheap or they're expensive. If you compare them to what they were maybe in a year ago, then certainly they are cheap. But if you compare them to 2013, when the actual real bull market started, when Raghuram Rajan took over as RBI governor, then you're seeing comparable type of valuations, or maybe even more expensive right now than what they were in September 2013 on price to earnings, price to book also. So I think it's not fair to say that stocks were cheaper 2 months ago, therefore buy them now, they're even further cheaper. I think a lot of things have changed in 2 months as well. And this kind of an economic slowdown was something which actually nobody had visualized.
I get
what
that
was
point.
appearing to be just an auto sector slowdown and
No, I get that point. But the only reason I asked you that question was because 2 months ago, and probably even prior to that, a lot of conversation around how the mid caps and the small caps and their valuations are 1 standard deviation, 2 standard deviation away from mean, and how that historically hasn't happened, and there is a possibility of mean reversion, and therefore start looking at these stocks, and that's precisely the reason why I asked you the question. But go ahead, you were making a point.
No, I don't follow this standard deviation and mean reversion. I really don't understand that. I don't follow that. But all I can say is that a lot has changed in 2 months. And if 2 months ago also, if I have said on your channel or anywhere else that stocks are appearing cheap and attractive and they've slid further from those levels, I think all I can say is that 2 months has been quite trying for the stock market, for the companies. And we've seen a horrible earnings season where, apart from a sector like cement and a few stray pharmaceutical companies, 2-3 large cap IT companies, by and large 2-3 large cap private sector banks, by and large we've seen huge disappointments in the earnings. And there are very few safe havens, so to speak, at this point of time where even your capital would get protected. I think even strong companies, look at what happened in Titan, what happened in Page Industries in this quarter, and the way they have corrected because of general overall economic slowdown or whatever the challenges were at the ground level.
Okay, that's the view coming in. While Nifty could be flat in last 1 year, it is the broader market which has seen more pain. Nifty 500 index, if you look at that in last 1 year, that's down about nearly 11%. But talking about the indices, the PSU Nifty index has lost about 20% over the last 12 months. And while it has 20 constituents in the index, it's the 4 Maharatnas that have dragged the Nifty lower. And Yatin Mota is here with more details on that. Yatin, over to you.
Well, if you look at the Nifty PSC index, which is basically the public sector enterprise index, clearly there is a lot of pressure. 1 year, the entire index is down broadly to 20%. More importantly, we have half the constituents of the 20 which are at a multi-year low, multi-decade low, and in some cases at life lows. Talking about some of these Navaratnas and Maharatnas, a lot of wealth erosion is seen. In fact, if you look at ONGC, a large amount of market capitalization erosion is what we saw. The stock is probably at lowest level since 2009. Similar is the case with BHEL. It is again trading at a multi-decade low. Also, if you look at the other 2 stocks in the pack, we have SAIL as well as Coal India. These are also the 2 stocks which are trading at multi-year lows. In fact, Coal India has today hit a fresh lifetime low. So, a lot of pain is seen as far as the entire PSC index is concerned. And let me also talk about SAIL. That stock is down nearly 45% on a year-to-date basis. Nalco, another metal name in the PSU pack, that is down 41%. The insurance companies, both New India Assurance as well as GIC, these are also the stocks which are at life lows. Amongst others, we have Coal India, ONGC and Oil India. All of these stocks down anywhere between 20% to 25%. Talking specifically about SAIL, since the chart is on the screen, the stock is at the lowest level since 2004. BHEL is at a 15-year low. ONGC is at a lowest level since March 2009. And as I was mentioning earlier, Coal India, the stock which is at life low. Outside, the PSC index, we have the Navaratnas, including MTNL, Navy Lignite, and Shipping Corporation of India. All of these stocks are also at a multi-year low. In fact, if you look at MTNL, it's fallen below the 1993 level. So that is the kind of stress that we are talking about when it comes to the stock prices of these public sector units.
Well, thanks a lot, Yatin, for bringing that information. Coal India, I remember the IPO price was somewhere about 245. It listed in 2012 or 2013. It's now down 180 points. And if I'm not mistaken, after the listing, there was a time when this also surpassed the market cap of Reliance Industries. Now, remember, Reliance, of course, barring last 2 years, it had not performed in the last 8 to 9 years. What a wealth deterioration story this has been. But remember, this has been a favorite for a lot of these investors or mutual fund houses because of the dividend yield it offers of about 7 to 8%. And even at current valuation, it's trading way below its average historical valuations of last 5 years. That's Coal India for you at 180.
Actually, even if you go to see Coal India, with regards to its return ratios, is one stock, rather one of the other PSU stocks which has done relatively well on both its return on equity and return on capital employed. So far up until now, but any which ways, because of the fact that there is more supply that the government keeps undertaking with regards to all of these PSUs, the demand for these stocks is not there too much in the market. So if you see the CPSE ETFs, there's constant selling, and then there's that much more supply that hits the market with regards to some of these PSU stocks. So the takers are not there, even though the return ratios are relatively healthy compared to some of their other peers. Rahul, anything that you've spotted, and comment on Coal India only.
Yeah, as you look at the Coal India, again, this stock has been beaten down significantly in the last couple of weeks from the levels of 270, and currently it has made a low of 177. It is near its lifetime low, unchartable territory, where the prices have come first time after the listing. And last 5 to 7 trading session also stock has been beaten down from the levels of 215. Maybe some sort of sideways movement could be seen or some sort of pullback, but for a reversal in the trend, stock needs to consolidate, or this intense selling needs to get exhausted. So I would be watching out at current levels. We'll watch out for the price behavior and then we'll take a call, but definitely I would not be a seller at these levels. Now we're talking about my calls. I have a buy call in L&T. Stock has made a low of 1283, and again stock is trying to see some sort of pullback from the lower levels. Swing traders can buy at current levels with a stop loss of 1270. On the upside, I feel that it can test the levels of 1350 in short to medium term. Again, a contrarian buy in Tata Power. On the daily charts, I mean to say last couple of days, on a 1 minute chart, stock is in the process of making an inverse head and shoulder formation. So one can buy Tata Power between 53 to 52 with a stop loss below 49. Upside, I feel the stock can test the levels of 61 in coming days.
Okay, so those are some calls. By the way, Coal India had overtaken the market cap of Reliance in 2012, which means the listing was in that year. But that's the BQ alert that you're seeing on the bottom of your screen. Just pull up the Indian rupee to the dollar. I think it's approaching very close to the mark of 72 now to the US dollar. It's trading almost at a day's low. Now remember, rupee had been trading at 6 months low. I don't know if with this sort of level now it's at yearly low or not, but it's depreciated more than 4% just in the month of August, and post the currency war sort of situation started after the Chinese yuan had crossed that important threshold of 7 to the dollar. Since then, we had seen a lot of emerging market currencies also coming under pressure. Deepan, I would like to come to you with the currency situation also now, especially in this particular month. We've seen the rupee weakening. It's down somewhere about 4.5% to 5%. How will this stack up things for the companies or for the industry at large when we are already seeing economic slowdown happening? And in fact, now there are talks of first quarter GDP numbers could be somewhere about 5.5 to 5.6.
Yeah, I think there's no denying that we are in a recession, and the kind of sell-off which we are seeing in the markets and the sentiment is also affecting the rupee rate, and it shouldn't go down, because consider the kind of reserves which we have, which are at all-time highs. To see this kind of a decline in rupee certainly is disappointing. But then, it opens up an opportunity as well from a stock market perspective, and maybe pharmaceutical companies and IT companies which are not, which are kind of insulated from at least the economic slowdown over here, they may be better placed because the rupee has depreciated. But it doesn't bode well for the economy, because it has its linkages to inflation and other related financial issues. So I'm not happy with the rupee depreciating, but yes, it does benefit certain specific businesses, and investors can look at those businesses at the appropriate time.
All right. Anything that, obviously in these market conditions, it's difficult to really pinpoint and say what could be a value generator. But historically, keeping in mind that some of these good parentage stocks have done well, they've managed to withstand the selling pressure that we've seen in the other stocks. What would you recommend now if you had to probably allocate that additional incremental cash flow? Where would you deploy it?
So I think there's still merit in buying with a 2-3 year type of a view. Interest sensitive stocks, so that could be NBFCs, could be auto, could be real estate, but these are low conviction thoughts at this point of time, and the way the market is correcting, even if you had 100 rupees to invest at this point of time, you just wouldn't want to take a chance at even 1 rupee just now. I think market should create a bottom over the next, not the final bottom, but at least some kind of a bottom over the next week or so. And then depending upon what the price points are, one could look at investing. And a lot depends upon the risk appetite of the investor also. And if you have a very high degree of risk appetite, then there are many stocks which are down 30-40% or so, and one could look at investing over there. And if you have low risk appetite, then you always have the HDFC Bank and the Asian Paints to invest in. So I think it's a very unique. It's a decision which is unique to every investor, and one cannot really say exactly which stocks they should invest in.
Got that. Dipan, we'll let you go on that note. Thank you so very much for joining us this afternoon. Hadrian and Rahul, just stay on with us. The Nifty is falling swift now, so we are 10,745, more than 1.5% right now. This is the lowest point of the day. We should actually get in some more market opinion on the index. Nifty Bank now down almost 700 points. And actually, if you could get the point contribution or the MRR function for the Nifty Bank, it'll probably tell you where that pain is coming. This is on the Nifty point contribution. And HDFC Bank, they're right at the top, HDFC Limited. But the MRR function of the Nifty Bank will tell you, what kind of moves we've been seeing across the board. Yes Bank obviously being one of the key contributors on the Nifty Bank, HDFC Bank, HDFC Limited, all the big wigs there also contributing to this 2.5% drop on the Nifty Bank. We're going to take a very short break on that note, but when we come back, we'll get you some closing ideas, we'll get to the Fab for stocks of the day and some more market opinions. Stay tuned.